Hey, everybody, welcome to week 161. I don't know why, but it just makes me laugh because I think, really? We'll keep doing this as long as somebody finds value, right? And yes, we are being subliminally overt with, we're in the BGW studios and Jack is in the Shoemaker studios and Adam has just joined us. So, yeah, we're going to be talking about financing options. Man, that has been something that I have heard many times in the last couple of weeks, in particular, from businesses. Just wondering about that. They've been concerned. Even talking with bankers again yesterday about what's going on. So the good news is there are some options that we'll talk about, whether it be equipment financing or other alternative financing deals. So we'll talk about that, but also thought we might want to have just a quick update because, hey, it looks like we got a deal on this debt ceiling. I mean, it is a pretty big deal. So Jack, he's always so good about having like visual aids and conversations. Like, he's done his research. He's a lawyer. So Jack, why don't you go ahead and give us an update on what's happening on Capitol Hill?
Yeah, and if I chime in before Jack starts,
Sure.
I thought, both kind of sides sides, meaning, McCarthy and then the White House, in terms of like announcing the deal, kind of had their own political slant on it. And at the same time, I personally have a feeling of like, yay, what kind of crisis averted, but more so like, yeah, man, I can't believe they got a deal done.
Yeah.
Meaning I hope that they would, but I was not super positive. I figured we're going to be down the track of shenanigans. But what I felt like it would, I felt like what could be lost in the presentation was something that McCarthy said that I think is very important, for us to remember as we talk about tax rates, and I think I've been pretty clear about, look, at some point, either we got to cut the spending or we got to raise the taxes or we got to do both. Because, I would agree with Kevin McCarthy that the level of spending is unsustainable. Something has to change. Period. You can debate on how to make that change happen, but status quo, not good. We keep on racking up too much debt. But something that he said was, well, look, you can't rule out, or you have to rule out by default, the payments on the debt itself, because that's the subject that you're freaking talking about. So that's off the table. You're taking defense spending off the table, and you're taking Social Security and Medicare off the table. If that's what you're taking off the table, as Speaker McCarthy pointed out, you're really only talking about 11% of the budget. So, I mean, if Gary and I were at BGW and we said, hey, Gary,
We are at BGW.
We're having a discussion on the budget, and we say, off the table is any discussion around 89% of what we actually spend money on, and we're only going to talk about the 11%. There's only so much you can freaking cut, like, right, without that you actually can cut. Like, because you can't cut half of it. Right. But like I can't cut, like, if I said everything's on the table, in that 11%, how will I cut half rent? Like, I suppose I could, but there's other consequences. Like, can I cut the IT support bill? In other words, like, there's just only so much. Like, I agree. Like, look, there's only, you can debate all day long, was that the right approach or not the right approach? But I think on the best day, if you were going to say, we're going to carve out, can't talk about the payment on the debt because that's the subject. So we're left with carving out defense spending and Social Security, Medicare. Well, you're only left with 11%. There's only so much you could actually cut on that.
Mhm.
And at the same time, if you said, well, but they were kind of big babies, didn't talk about Social Security, Medicare. By the way, Gary, last time I checked, we both have taxes that are funding our Social Security and Medicare accounts. So you want to talk about cutting my benefits? Guess what conversation I will be having with you next about the tax revenue. So my point in saying that is that even if you talk about Social Security, Medicare, the delta between tax collections and tax outflows, if you just isolate that program, those programs in isolation, maybe 3 or 4%. So like on your best day, maybe they could have been talking about, 15% of the budget. If you're not talking about
Yeah.
debt and you're not talking about defense spending, that's a long way of saying like, look, dude, as much as I don't like it, tax increases with tax increases without somehow killing the economy seems like the only path forward. If the only thing that I'm allowed to talk about is 15% and closing $1 trillion
Yeah.
annual delta in terms of outflow versus inflow. Hey Gary, we've got a major spending problem. BGW spends $4 million more than we bring in every year, but price increases are off the table. 89% of our costs are off the table. Well, actually, I'll give you one. 85% of our costs are off the table. So basically, we need to take $1 million in spending to close a $4 million gap. Go. $1 million in spending needs to cut a $4 million gap. That's by the way,
That is a practical
that's by the way,
example.
$1 million in spending in totality. Like if we cut 100% of it.
Right.
So it just, I don't know if that's how the actual math shakes out on the budget deficit. I'm pointing out the nonsense of what you hear on both spectrums, whether it's the far right saying should have been no deal. We should, like, how much were you really going to freaking cut if you got everything that you wanted?
Right.
It wasn't going to be a whole lot damn more than there actually was cut.
Right.
Or the far left is saying full speed ahead, sir. Yeah.
Spend.
No cuts for anybody. Spend like a drunken sailor and, tax the hell out of everybody. So anyway, tirade done. Go, Jack. Try to pull us back.
Okay, here we go. I'm pulling you back.
Yeah.
So, and yeah, absolutely. I agree with all that. And I think that part of it is also, it is the spin on it, right? Okay. So, yeah, I think it was in the Wall Street Journal, the information was, cut spending by 1.5 trillion over a decade, by freezing some funding that had been projected to increase next year, and then limiting spending to 1% growth in 2025, which is considered a cut because it would be at a lower level than inflation. So, when we talk about cuts, it's not, it also includes reductions, and not necessarily just cutting out programs or basically punting on it in completion, as as was said. So, and then it allows clawback for some funding for IRS enforcement, and then unspent coronavirus relief money. Wait, what? There's unspent relief money? I thought they spent all that money and gave it out to everyone, right? Okay, so
Isn't that
that's
like
also,
a no-brainer? I mean, like,
I mean, it's
Pandemic's over per government declaration, but we're going to keep the money reserve. That's
Right.
the dumbest freaking thing that I've ever heard.
yeah. Yeah, congratulations on Captain Obvious on government.
It's like that's a freaking layup.
All right, and then the graphic that I wanted to show is, let me see if I can pull it up, is interesting because I'm always curious as to, you hear it's a lose-lose or a win-win, and that means that there's people that are obviously unhappy in anything that you do, right? And then so I look at this and found this interesting
oh,
graphic,
there you go.
which is, so all the tan ones are the ones that supported it, the opposition, and you see the opposition is polarized, right? You would think that, okay, well, there would be a slant towards one side being kind of more all in, and then, more all out, but you have, and I guess maybe that makes sense that you have the polarity of the
Yeah.
vote, but you kind of think about, but it was an interesting kind of visual to see, okay, well, here are all the people and here, and they, call out two people in particular as to where that person voted. So just wanted to share that graphic on that.
So MTG, it looks like she voted for it.
Yeah.
I think her and Jim Jordan both voted for it, because
Interesting.
they've done, I mean, they've, to their, you're not going to hear me go so far as to saying that I have a little bit of respect for Jim Jordan at this point, but, MTG, she's actually made a slight few comments that actually make a little bit of sense to me.
Yeah, that's a very interesting graphic, man.
All right.
Your Google prowess is still unmatched as far as I'm concerned. Hey, while we're on this, before we get into own like business financing options, like what do you do if the bank is tightening it up, which by the way, they probably are. Robert Mayetta, good to see you here, buddy. He raised this question. So the question is, while I'm getting Norton's status updates, thank you. Assuming the bill on the debt ceiling will be signed into law, does this mean that the Treasury will then need to issue 1.2 trillion of new debt over the next 3 months just to repay the extraordinary measures taken? Won't that shock the system and cause interest rates to jump up? That will make it more difficult for business owners to borrow from the bank. Am I wrong on this forecast?
It's a good question. I don't know the actual numbers of what's going to have to get sent out there. But I think in terms of they're going to have to do this anyway. So my response to that is probably unlikely to cause any change that wasn't already going to occur anyway, which I think is sort of the topic of discussion is, it's getting harder to borrow money. And it seems like that whatever was going to happen, this likely won't influence that. In other words, it's going to be bad. This might make it slightly worse, but it was going to be bad anyway, I think.
Yeah, I think there's always going to be attribution, or it's going to be attributed. Interest rates are going to, modifications are going to be attributed to anything that is out in the environment. And this is definitely one of them. So you'll have people that will be on both sides of that, well, it doesn't really have an impact because, as Adam said, it's just, a truism. It's what's going to happen, and what just happens when you have to deal with treasury issues, and I don't want to say making fake money, but I mean, so modifying the standards and dealing with issues and creating capacity on paper rather than, I guess, I don't know. I imagine in the old days when there was actually value linked to gold, that, actual gold bars were being moved around and horse carriages and stuff like that. I don't know. Maybe that's just something I saw in a movie. But yeah,
They were carriages. They were
Yes.
armed carriages.
Yeah,
Yeah.
you saw it in the movie Time Cop, Jack.
That's what it was. Yes. And actually, I have the Wells Fargo carriage, and I have all of the horses, because on an annual basis they would have new stuffed animals. And I think many people on here know that my daughter is an equestrian competitor. So that was, thank you, Wells Fargo, for that takeaway. That was a wonderful gift for a young lady who was in that world. So, but yes, I have the entire team of horses. So it could have been from there. But anyway, my point is that yes, I think interest rates will be impacted by this, but whether it's what the level of attribution to the impact is questionable, depending again on which channel you choose to listen to in your evenings.
Yeah. Go back and forth and maybe you'll find the middle. I don't know. It's hard to find the middle right now. I think middle America. I was back in Kansas last weekend and that's about as middle as it comes, man. It was good to be back in the Midwest, but I like being back with hills and trees in Charlotte, North Carolina, even better. So I know we've got one person on this call that couldn't be on last week. We talked about it, I think in theory, you guys did while I was flying to Kansas. But the scenario was about the potential for doing an acquisition, a large acquisition that would be bigger than a bank could probably do. And the question was, what about doing a reverse acquisition through a SPAC? Special Purpose Asset Class, I think is what that stands for. We looked at doing one when I was in private equity in 2005, and man, they were all super shady back at that point. We were like, So anyway, Randall, I know you're on. If you want to ask a question, hit us up in that Q&A button and type it in, and we can address that. But let's go back into the higher level question before he tees that up. If you still want to do it, maybe you got everything you needed from last week's conversation. And if so, that's great. But all right, so, and I've seen that there are some bankers on this call just looking at the attendee list. What I heard yesterday from another commercial banker is like, yeah, if you're in commercial real estate, or if somebody's looking for commercial real estate and it's not owner occupied, nope. From, what was it? Jack, was it you? Somebody was talking about San Francisco, their vacancy rates in big commercial buildings it's like astronomically high. Kind of think 2008, 2009 kind of time. It's high here in Charlotte, but not nearly like what it is in San Francisco. So you got people that aren't wanting to lend for some of those reasons, but also because of what's happening with interest rates and the banks maintaining balance sheets, right? So let's talk about, and you've got plenty of real world examples, I'm sure, Adam, with some of the conversations we've been having in this last year. Hey, what should I be doing? And even if your bank is open, what about equipment financing and those kind of things? So let's talk about that.
Yeah, I think, what I thought would be helpful, Gary, is I could talk about the couple things, one thing definitely not to do, but it is a financing source. And then, kind of some layups that you could do yourself. And then maybe Jack, you could get into, some more subordinated debt, alternative structures, stuff like that you've seen that are out there. So I'll give you plenty of time to do that Google research. Anyway, so I wanted to start off with, and thinking about this topic about, hey, what are other financing sources that are available? As I'm preparing myself, I wanted to get into the what not to do first. The absolute, do this as a last resort, and even then, don't do it. Do something else instead. Not upon our advice, I am aware of clients and companies that have used payroll tax money or sales tax money to finance their business.
Yeah. Okay.
That, people ask me all the time, man, am I going to go to jail for this? Am I going to go to jail for this? And I'm always like, nah, dude, look, the IRS, North Carolina Department of Revenue, they're not like that. With the lone exception of that's guns drawn, because you're acting as a trust for the government. And that's just an absolute, no to do. But, that being said, while I don't recommend it, you paying your income taxes is, you know, in some respects a little bit variable, because you're the determinant of how much do you need to pay on a prospective quarterly estimated basis. So that is kind of, you know, that is a source, you know, like if somebody, if something's getting pretty tight, you know, and I've got a quarterly estimated tax payment due, well, it's tight for a reason. It's probably because I'm not making a lot of money, you know, and that would mean that I can choose an option that allows me to delay or defer that tax payment until I have better information to determine what my tax obligation actually is. So my point in saying that is, you know, sales tax, payroll tax, no. Really digging in and evaluating what are the estimated payments or extension payments that I actually need to make to support my income tax obligation. That's got to be on the table, you know, as an option. You know, ideally it would be, you know, one of the latter options, but that's got to be on the table as an option. I think the other one that I would touch on too, that, you know, people really don't look to enough, but it can make a huge difference, is your accounts payable and your accounts receivable. And what I mean by that is paying vendors a little bit slower and trying to get your payments from customers a little bit faster, you know. And if you look at like the extreme example of that, you know, I'll get this wrong, but it's directionally correct. But, you know, Walmart, you know, they're collecting money on the same day, you know, that they sold Gary the money, you know, and yet at the same time, they're paying the people that put the inventory in that store in 90 to 120 days. So they have created a cushion. You want to do business with Walmart? That's just the way that's going down. You know,
GE, same way.
so
It's 120 days
they've
first.
created a window of, you know, 90 to 120 days worth of sales. That's just a source of financing, like that my supplier is now my source of financing. Guess what? It's interest free. You know, I'm not saying be a jerk about that. I'm not saying change that overnight with people, but I mean, what I found in a lot of our clients is that your finance teams are generally way more excited and stressed out about paying the bills than they are about collecting the loot. You know, and that needs to be an attitude shift. You know, you need to be way less excited about paying bills and way more excited about collecting the loot. So, and you know, people get sneaky too, you know, like I'm going to send you a bill. What are the terms upon receipt? You know, and it's backdated. Oh, we got to pay this tomorrow. No, you don't need to pay it tomorrow. So I think really digging in and saying, you know, what's the frequency with which I'm paying bills and prioritizing those into kind of got to pay these current, I could pay these in 60 days. I could pay these in 90 days. Is a good habit, you know, to be in, because if you can create a difference of, you know, 15, 20, 30 days between how quickly you collect your receivables and how quickly and how slowly you pay your payables without being an absolute jerk or getting cut off, you can generally create, you know, anywhere between a month to 2 months worth of cash flow, you know, just by making that move. If the numbers are big enough. So I really would look there, you know, first as my first form of options, because I am not dependent upon anybody for that. I am only dependent upon myself for that. And then the last thing I'll hit on before I punt over to Jack is that the next, you know, some people hear this and like, oh, sweet. So I'm going to get into, you know, accounts receivable factoring. Then, you know, I'm going to get, which is basically, you know, I'm going to go to Gary and Gary's going to buy my receivable from me and exchange it. I mean, that's like the business equivalent of a payday loan. And if we were individuals, we would not be in the business of we would not want to do payday loans. Payday loans would be the thing that we would do if there were no other options available to us. And while factoring can be a viable alternative for people, you know, especially based on the nature of the business they're in, you know, or maybe that's the only option you've got available. If it's not something that's normal and routine in your business, and frankly, there's only so many industries where that is like the normal mode of financing. If it's not something that is normal for your business, but you're like, hey, I know what I'll do, you know, please try to avoid that one too. You know, figure something else out, because the effective, it's like once you're in it, it's like a payday loan. It's real freaking hard to get out of it. And the interest rates, when you play them out, are pretty darn high.
All right, I'm up.
You're up.
So a couple things. First of all, have a lot of clients over the course of time that have come to me and said, well, you know, I'm thinking about raising capital, and you know, have some people that want to buy in, whether it's a key employee or someone, and yeah, it's like 10% of the company, no big deal. Well, when you're towards the not infancy side of things, but growth, 10% probably maybe doesn't have a whole lot of value in comparison to the monetary value, but also the opportunities that money provides operationally and for growth. That if you brought that money into the business from these investors would be pretty significant. The problem is that when you fast forward 10 years later, that 10% may be worth a lot. And in the meantime, what you've done is with those investors, and maybe that you've set them up with preferred distributions, that they get their money back first. They get paid on and paid back their investment first, and have provided other perks, whatever it may be. And the question comes up, what do you mean I have to pay them that amount of money? It's usually more of, what do you mean I have to pay them that S ton of money? And the answer is, well, that's what you agreed to. Well, we didn't think we were going to be, you know, as successful. And I'm like, and so I look at them and I'm like, and I feel bad for doing this, but that's what I do. I look at them and I'm like, so did you not believe in yourself? That kind of thing. And they're like, well, no, of course I did, but it's just been wildly successful because of XYZ. And I'm like, that's fantastic. But yes, you do owe them that money. So what I'm saying is it takes a lot to convince me to utilize just the freewheeling giving away of stock in exchange for bringing in funds into the business. Now, there are maybe safer ways to do that, which is a hybrid, which actually I'm working on this morning, which is taking investor money in the form of a loan with a low interest rate that is not paid out, but it is basically put back in. And they're working through, is it simple interest, is it compounding interest, et cetera. But at some point down the road is exercisable and exchangeable into equity. And therefore there is no payout back to the investor. What that does is that protects the investor in the short term. So if they need to call the note, or they need to, you know, if they're non-payment, they can enforce the terms of the note. But in the long term, but it also allows the business to not feel like it has to, you know, now start repaying the principal and the interest, et cetera. On the other side of things, for, you know, is that on the longer term play is that you become an investor in this company, and which is great if it's successful, but if it isn't, then you don't have to convert the note to equity. So an interesting solution too. And, you know, there's tax consequences with all of that, but, you know, the goal is to find the middle ground as between not giving stuff away, but also utilizing people's money as an infusion into the business. And so there's that. You did talk about, you know, traditional AR financing. I hadn't seen that in a while. That seems to be coming back, where businesses are leveraging off of basically selling their receivables for that payment is received down the road, and by the investor who has factored the receivable, but then you get the cash at a discount. So whether it's 80%, 75%, whatever it may be. But, keep in mind that the liability typically remains on you for collectability, meaning even though you got 80%, you may have spent the money, but if it doesn't get collected, then you're typically responsible to pay the factor the 100% that, or the amount of money that they gave to you plus penalties, et cetera. So please don't after this go out and be like, oh, let me find an AR factoring company and sign up with them. You need to be very careful because one size does not fit all, and there are many variations of what that looks like, kind of coming back and forth. But and yes, I acknowledge that we have some bankers online and others that will review this on rerun on our YouTube channels. But I mean, and I've said this before, if you were to ask someone point blank as to, are you lending money? The answer is no, or probably not. It really depends. But there are people out there that are lending money, so you can find them. It's just that there's a price to pay for whatever it may be. It may be that they, in exchange for the money, do go down the route of a loan convertible to equity. So they are basically taking the chance that, maybe the better route for them is to convert to ownership in your business. Now, obviously there are regulations and other things, banking regulations and other things that you have to go by. So I'm not suggesting that it's that easy to do that, but so that's another option as well to traditional financing. I've seen a lot of money come from friends and family, which is fine. But then it seems to morph into something else, which is, let's see about getting money from strangers. And I'm not talking about like crowdfunding, but although I see a lot of that too, I'm talking about actually going out there and sort of crowdfunding, which is posting something on Facebook that says, hey, if you have an interest investing in this kind of company, blah, blah, blah. And when I see that, I cringe. I immediately tell my client to take it down, and I explain to them the reasons why, which is, now you're in the world of securities, which is highly regulated. The best route to go in that circumstance is that if you're launching and you want your net to be larger, is to go find people who have a lot of money. That is officially known as an accredited investor. Because under federal law and most state law that follows that, or has their own exemptions to registration of a security, rich people are deemed to be either sufficiently knowledgeable, or they can hire people to be knowledgeable and advise them. And that's my paraphrasing of what that is. And then there are certain standards as far as what your net worth is, net income, and those kind of things, as far as you becoming an accredited investor. And there are various ways of doing certain things. Like you can mix together accredited and non-accredited, but there's rules associated with that and what you have to disclose to others. But the best case scenario is to be under what's called Regulation D, and it's a 506 offering. So it's section 506 of Regulation D, which basically says that if you have essentially, and I'm not being derogatory to rich people or being elitist or anything like that. It's just kind of the simplest interpretation of it, which is you have a bunch of rich people that can read minimal. You still have to disclose risk factors, the good and the bad, like you do, but you just don't have to do it to the extent that you would have to do an offering circular or a prospectus or anything like that. But you do have to provide certain information, but it's very basic information essentially. And then they sign off on a subscription agreement, and you get their money into working for your business. So, and the next question usually is, well, how many people can I do that for before I have to, how many rich people can I tag before I actually have to do a Reg D offering, a 506 offering? And that is subject to interpretation, and I think depending on the circumstances. But the reality is that doing a Reg D filing is pretty simple in the scheme of things as far as doing things and filing things with the government, that it's really kind of a no-brainer if you're looking to bring in millions of dollars into a business from people who you know, and I'm not saying $1 million from like 2 people, I'm saying $1 million from several people total, that's the best way to go for the most part. So my point in all this is that there are various ways of bringing money into the business outside of traditional financing. And those opportunities are out there, but you have to be guided down the right path in order to get to the place where you're able to solicit for those funds.
Having been in that Reg D world where it's a 99 investor cap, you can't have more than that. When I was in private equity, that's the world in which we played. And we were extremely picky about who we allowed in, because I can guarantee you that just one squeaky wheel, and it's usually somebody that has the least amount of money in, becomes the biggest pain in your side. So it's like, beware, because $1 from the wrong person will make your life not so happy. So yeah, I'm glad you brought that up. So Randall kind of, because he's on, I know you guys addressed this last week, but he went ahead and kind of hit his questions. So that, you know, he's looking at Reg D PPMs. That's basically they're a good sized company looking to acquire a bigger sized company, and it's a lot of money. And the banks are probably going to say, are you kidding me? What are our options? And so he said that the situation, one of the situations he was looking at was a reverse merger, different from a SPAC, and a special purpose acquisition company. I had that wrong. Which a company is formed to acquire another company. The reverse mergers acquires a public shell basically, which the acquirer buys control of the OTC company. Go ahead.
Yeah, so I hit on that because we, you know, so it is an option. And it said Jack, yeah, it's funny, Jack brought up a screen because we did cover this. It's the upper scenario. We did cover this, and I think here's my opinion on it, is that you have, it's really freaking expensive, because you have an audit that you've got to do, you know, so let's say that's, you know, $50,000 to $75,000 a year. And this is like live based on my experience. You've got that first audit, that because what ends up happening is you got this publicly traded company that's sitting over there that's basically been dormant, that still had to have an audit, but it's got no activity, so it's pretty simple. So all of a sudden you are putting in operations that have a history that has to be audited. And that's messy. So my point in saying that is, you know, the accounting fees alone in that type of transaction are probably going to be $300,000 to $400,000 in the first year, and then, you know, $50,000 to $75,000, if not $100,000 in steady state thereafter. You've got the legal fees associated with it, and it's just, you know, when you look at like the total fee to do it in the context of the money raised, it ends up being it could be a pretty expensive form of capital for you to raise, you know, when you just think about it in the context of interest rates, or like, could I just say, hey, let's do some seller financing, or I just pay a little bit higher interest rate or whatever, right? And on the flip side of that, you think, oh yeah, but now I've got access to capital markets and publicly traded companies and stuff like that. It's like the other side of that is you also have to think about that in the context of like, look, dude, I still got to be a stock that somebody would want to buy, meaning like, what's happening is you're still having to get an investment banking firm to underwrite the transaction in a way that they're creating something that other people would want to at least make an initial investment in. So that's got, that's something, independent of that, you've got really no volume history. I mean, this applies to SPACs too, but you really have no volume history to go off of in the transaction. And usually the shareholder concentration is going to be really high. In other words, like, we're going to do this reverse merger. Let's go raise money. Who do we raise money from? Me, Gary, and Jack. We're guess what? We're the market. We're now the market for XYZ company. We're the market maker. Well, if Gary, it's like the prisoner's dilemma. If Gary's like, hey, dude, I'd like to get out of this, and he dumps his stock, I'm screwed, because he's the market, even if he could find a buyer for it, So usually, while they don't tell you this up front, by the time you get, 3/4 of the way into the deal, you've already dumped a ton of fees into it. And you're like, look, I mean, we're 7 months pregnant. We need to carry this baby to term. Now come the volume restrictions and how much you can actually sell. So you just, you gotta make sure that that there's actually a market for the stock. And to use this as an example, Aquesta Bank, before they were acquired by, I think it was United Community bought Aquesta Bank. I mean, they were in my neck of the woods. The reason it stands out is because, I started my version of BGW the exact same year as Aquesta started. And I got to know Jim Engel, the CEO, pretty well. He's a good guy, and, they just, had a liquidity event where another bank bought them. And not known to very many people is that Aquesta actually was a publicly traded company for a period of time. Like Jim did take them public. I mean, you actually had, like, I could have bought without like going whatever, I could buy the stock. And I mean, he did that to try to increase a little bit of the volume, but it didn't, and Jim monitored that. I mean, he's a super smart guy. It didn't change the volume a lot, So it's like, I never went back and asked him, hey dude, was it worth it or not? I don't know the answer to that question, but what I can tell you that he answered as the question is that it moved the needle on the volume, but not much. And that was in the first couple of years, of them being public. Now somebody on this is going to like play at the gym and he's going to go tell me to go to hell. I actually did. And then he's going to send me a volume chart and prove me completely wrong. So it's based on some conversations that I had with him, because it's what I was curious about, like, okay, you went public and threw a party. Did it actually change anything?
Yeah.
So it's another one of those things like, look, dude, I mean, don't forget that a capital market is still only as good as you actually have a market for your stock. And price is a component of that, but an equally important component of that is trading volume. Like, there actually has to be people willing to actively trade in it once it's done. Otherwise, you kind of were one and done, So just it's something to think about. But if you can solve for those problems, like, hey, I'm okay with the fees, raise a lot of money, I'm reasonably confident based on either our track record or like the thing that we're doing or whatever, or, other examples that we'll get we got a plan to get the trading volume where it truly will act as a platform, then I'd say, look, it's got to be on the table. as an option.
The one
Um,
thing that I would say, like back to my comment of $1 from the wrong person will make your life, difficult. We took 20 million bucks in from a publicly traded company. We didn't really need it, but it seemed like it was a strategic move when I was the president of this company and my chairman took it. And because of all the rigmarole that goes on with publicly traded companies, and even though it was a minority stake, we still had to go through a lot of regulatory hoops. And this guy is like sterling, like he is just by the book, really good guy. But he just didn't want people messing in his stuff anymore. And he gave the money back about 18 months later. He's like, here's your 20 million bucks and said, get out of here. So decoupled the thing. So again, it can be good, but make sure you know what you're getting into. One other thing that I will say, and it's kind of on a completely different tangent, but this was from somebody on our LinkedIn post about it, and basically about this topic. He said, and he's with an equipment financing company, so you got to just take that with a grain of salt. He's like, hey, equipment financing can be a solution too, because even if you've got established lines of credit at banks, it's more prudent to utilize an equipment finance company to purchase your equipment. It keeps your bank lines open. So just,
Yeah, and
you know.
I actually would agree with that. I mean, a lot of our clients that are capital intensive for equipment, they're using equipment financing companies for that specific purpose. A lot of banks that also have special purpose equipment financing programs. It's just that, like that's not going to be, that actually is an option for BGW because that's how we buy our computers. But at the same time, and our office furniture, but at the same time, that's not actually our capital need. Our capital need is people. So it's an option, but it's only an option available for a select category of clients that have equipment purchases as their primary kind of air quote CapEx cost. Because for us, investment in people is our capital expenditure, even though it's a P&L item. The other one that I wanted to hit on too, that we see, especially in times like these, and to go back on the financing point, I mean, I think the general consensus opinion out there is that, look, dude, unless you're an existing customer of a bank, it's going to be real tough to get any new credit, just period. That's, that if someone's telling you differently, that is contrary to what we're hearing, and if you are successful, God bless you, and good for you. So, and yeah, another option that's available that's out there, subordinated debt, mezzanine debt, it's got a lot of terms, but basically it is, loan sharking, best way to think about it. It's loan sharking, meaning it's higher interest rate, less strings attached debt. It's a viable strategy, but that is going to be the best fit for companies that are really confident in their ability to grow rapidly and generate positive cash flow. Because what we've seen happen is someone takes mezzanine or subordinated debt, high interest rate, they don't hit their growth objectives, they don't hit their profitability targets. And the neat thing about mezzanine and subordinated debt is when I go to Vinny the loan shark and and I go, hey dude, Gary's my bookie, Vinny the bookie.
Oh, great.
Dude, I totally, man, pooped the bed on that spread, but I feel really confident this week. Can we just double that down? That I'm good for it. Yeah. No, we're good. Tell we're not good.
Till I have to bring Guido with a pipe.
Yeah. So with subordinated mezzanine debt, the problems that you run into, and Jack, I'd love your opinion on it, whether or not you've seen this or if you've seen this in a document, more common than not, is like, a lot of times there's like demand features, you know, like, okay. you know,
Time.
and they're not like happy, worried about my reputation. I still got to work in this town type people. You know, they're demanding about their demand features. That meaning like, hey, we're gonna call the court and throw your ass into bankruptcy, you know, type features, you know, or appoint a receiver type features. That's one. That's less common. I think the more common scenario is, oh yeah, we'll let it ride. Oh yeah, we'll let it ride. Oh yeah, we'll let it ride. When it comes time to pay the piper, what I find is that the amount that I owed them, that I've now allowed to accumulate because I basically have been rolling the payments for them and just making de minimis payments on it. Because oftentimes they're like, you can pay even below the interest amount due. You know, you can pay like a nominal, you know, whatever, if anything at all. It's carrying. And I've got 3 times the freaking debt that I borrowed in the first place, you know, when it's all said and done. If you combine that with oftentimes debt like this is structured in a way that they have warrants, you know, upon a change in control or liquidity event, it's like, not only do I own 3 times as much, but when I sell the company, they're going to get all the freaking money, you know, based on the warrants and conversion feature and all that stuff. So it's another one of those things where really viable alternative, especially when it comes to like giving away equity. At the same time, the attributes really need to be, you know, very comfortable with my growth ability and my cash flow ability. It's like nobody can ever know that 100%, but you know, there's that versus like, oh yeah, no, I've got a spreadsheet to back up, you know, my projections, Gary. Well, that was still based on a bunch of bullshit, you know, like I'm talking like market research, you know, customer orders, like demand surveys. Like while marketing isn't a science, there is stuff that you can do to prove out whether or not you've got a viable, you know, strategy or not in terms of able to do what it is that you want to do.
Yeah, it's funny because Randall, so I'll just acknowledge some of the stuff that you've hit here. So I'm glad he says this is precisely the kind of input I wanted regarding the reverse merger. Everything he's saying is absolutely true. That's awesome. Part of the trading volume is related to the float. He also did mention, you know, the mezz debt comes with warrants, whereupon these mezz companies are going to want a 10x on that warrant plus 12 points on the debt. I mean, that may be a little extreme, but
Yeah,
yes, we've seen it's called sharking for a reason. He said there's a Charlotte company that took 90 million from Walmart a couple years ago. They just filed for bankruptcy, and somebody else just acquired their assets yesterday. Yeah, when I was in this private equity company, the treasurer of Walmart, former treasurer of Walmart, was our vice chairman. And he always said, yeah, be careful. You know, the good news is you landed Walmart. The bad news is they may put you out of business because, you know, they're sharking too, you know, quite frankly. So it really does matter, like, who are you doing business with? Now, this is completely different, but it's a scenario that we just ran into with Robert on a joint client, and it had to do with the I was going to say Tax Cuts and Jobs Act, but that's not it. It's about this other one on it was the one that Biden just did. I'm blanking out, but it had to do with solar credits. You know, that is they're building a building, and there are some available funds for stuff like that. The other thing that we didn't talk about, so I want you to talk a little bit about that, because that may apply to somebody out there that's in the process of building a building, you know, owner occupied, because we are hearing that banks are still doing some owner occupied financing on commercial. So I want you to talk about that. But the other thing that I would say is there's a guy named Tory Wood, and there are other folks, but he has a company called M&A financing. And when the banks aren't lending, he's got sources that are more credible than certain underworld cohorts. And he's a good guy. So if, and I didn't see Tori on here, he was going to try to make it, but if he can't, look him up on LinkedIn. It's called M&A Financing. Good guy here in town, Tori Wood, TORREYWOOD. So let's go back to the solar, some of the credits and grants that may be available.
Yeah, I mean, the two kind of the actual money back, items or source of financing that are going to be available are going to be, really like while sticking stuff in a distressed area is, a tax incentive, you're not really getting money back for that. You're just avoiding paying some money. With anytime you're talking energy efficiency, which would be solar, geothermal, stuff like that, you basically have two options. Option A is, hey, I get the money back through credits and accelerated depreciation on the equipment itself that I'm installing, or alternatively, you can get a loan against it or apply for a rebate credit, but not take it on your tax return. Same thing applies to historic, rehab credits. So it is something, to consider. You ought to at least take the free government money, when you get the chance. And again, the whole presentation, we didn't mean this to be doom and gloom. It's just more like, I think the punchline here is there are other financing sources available if you're running up against a brick wall with a bank. Some are totally entirely in your control, which is like accounts payable, accounts receivable, equipment financing, if that's the business you're in, that's available as an option. And then there's others that are available, but it's beware. There are going to be some pretty significant strings, so just make sure that you've exhausted all the other options available to you first.
And let me throw in a couple things. I know we're getting close to being done, but with respect to security interests, and we talked about equipment financing, there have been questions asked of me that, well, wait a minute, I have a bank, a lender who has a blanket lien on everything. Well, there's what's called a purchase money security interest, that the actual collateral, the thing that was purchased, is the collateral for the loan that was given to you, which is outside of that blanket lien. So, whether it's in that goes for inventory, equipment, and other assets, categories of assets, but there are rules behind who has priority under certain circumstances and what you need to do and what the lender needs to do with respect to protecting and getting that higher priority over a blanket lien. The other is that I would suggest that you go check your credit report and check your UCC filings with, if you have borrowed money in the past, if you've had credit cards, all those things, because what I have found, even on my own credit report, is there are some things on there that still show up as technically being open credit. It shows a zero balance, so it doesn't have a huge impact, but still, in the scheme of things, one of the factors is in your credit rating is how much open credit do you have at that time? And it's actually inaccurate because I closed that credit card or it was an older mortgage. I think there's a presumption that gets cleared out over the course of time as you go through life, essentially, and use other lenders, et cetera. But on the business side, when we're going through due diligence in a deal, whether we're buyer or sellers, counsel, we typically many times will find a UCC filing for security interest on a bank that was paid out 5, 6, 7 years ago. And for whatever reason that didn't get, and that holds things up. But that's also part of, making certain financial decisions. So make yourself and your business more attractive by cleaning out that sludge that may be in there on your personal and on your business credit report, essentially, or, with your UCC filings with the Secretary of State.
Yeah, that's a great point. So last question that just came in, what about personal loan guarantee insurance? You guys have any experience with that?
The answer to that is, while I'm aware of it, so basically personal loan guarantee insurance is basically, all right, look, Gary, I went to the bank, I had to borrow some money, they're demanding a personal guarantee, hey, if this whole thing went sideways, I'd have to pay the money back, sell the house, whatever, how am I ever going to do that? Geez. We've never had a client, to my knowledge, that has purchased it. So I cannot speak to how much it costs, because insurance at the end of the day is really a trade-off between, how much does it cost relative to the risk that I'm actually going to have to use it, which is a combination of probability and impact, So I think in the instance of a personal guarantee with most of our clients, their answer would be, I'm never going to friggin' default. So the probability is 0. Why the hell would I pay the money? Okay, got it. Check. I think the other practical side of that is just based on my experience, is that most people that have fairly significant assets that would otherwise be, something that they would be worried about from a personal guarantee perspective, typically, and again, I'm not advising, shenanigans that are illegal or anything, but typically if I'm worried and I kind of know that there's a chance that I'm going to go down in flames, about a year out to 2 years out, I'm going to start the asset protection process, so that my personal assets are protected from potential creditors. And then if crap does hit the fan and I got a default for whatever reason, then what I'm probably going to end up having to do is bankrupt the company, bankrupt myself personally, and just freaking deal with it, And so I don't know enough, since we've never had a client that has a personal guarantee insurance that is subsequently triggered a payout. I can't tell you what happens, when that happens, but it seems like one of those deals where like, well, the insurance company is probably going to be pretty pissed off about that too, and like, when's my lawsuit for breach of fiduciary responsibility to not run the company to the ground? Like, really, I could just run the company to the ground and paid you $100 a year, and now you're on the hook for, millions of dollars. Like, it just seems like that could be one of those too good to be true, items of like, well, why the hell wouldn't I do that? Here's what I'm going to do today. I'm going to run up a bunch of debt, buy an insurance policy, default on it all, and say, woo, it's all your all's problem now. And I'm saying that lightly. I'm just saying, like, well, I don't have any experience in people doing it, but in while I'm aware of it as a product, it feels like one of those could be too good to be true products. Jack, you got any experience with it?
Yeah, and I know we're into overtime period now, but I would say that I'm not familiar with it, but I would imagine it's more similar to posting a bond to secure an obligation versus it being like health insurance, which is unsecured. So I look at it as it being secured. What does that mean? That means that the insurance company is going to be very intrusive and ask you for, your DNA and everything else. That's facetious. They will ask you a lot of personal information, not along the lines of getting health insurance. So they're really not going to take your DNA. But the other is that they will ask for collateral. So it's kind of like, you're just signing up for something and kicking the can down the road, because ultimately, if you can't pay on the guarantee, and and the insurance kicks in, they're still going to come after you for what the collateral is. So it's insurance in the sense of, okay, they will pay, but then they'll come after you, not the sense of, from my understanding, the sense that it's like health insurance where you're paying a premium and then they pay out, and you don't have to pay them back, kind of thing. So, but I may be wrong, but I think that it's more of a kind of a surety type scenario that, it's just, again, intrusive.
Well, this was a lively discussion. It was good to have everybody that was on here. Thank you, Carrie Mast. Always good to see you on here too. Thank you. She said, thanks for the content. We're working with many non-bank lenders now to support capital solutions for our clients. So look up Carrie Mast, KERRYMAST, and find her on LinkedIn. She's got a lot of chops in the commercial lending world. So thank you. Reliable financials remain key. And she says, use BGW. Thank you very much. That's why we'll give you a shout out. So anyway, guys, it was good to be back with you this week. We will put this up on the BGW CPA YouTube channel, and I think Shoemaker has the same sort of thing. That will be up later on today, and we'll look forward to week 162 next week. Thanks so much, Jack. Good to have you back.
Thank you. Welcome to summer.
Thanks. Yeah. See y'all. Bye-bye.